Good evening, everyone. We're going to get started here in just a little bit. First, I just have a few quick things to go through. My name is Josh Julke, and I'll be the moderator tonight for PenFinancial Credit Union's Investing 101 webinar. I'm joined here tonight by our Huggins Street branch manager, Rob Taylor, and also Linda Larouche, who is an investment advisor with Credential Securities. If at any point you're having technical difficulties, I encourage you to let us know via the chat function on the right side of the screen. And we'll do our best to get that fixed for you. Also, we welcome questions at any point throughout the presentation. So you can also use the chat function on the right side of the screen and type them in there. And if there's a moment during the presentation where they can answer it, they'll do it then. And if not, they'll be happy to answer it for you at the end of the presentation. Now, as some of you know, November is Financial Literacy Month. So we launched a very special contest on social media called #TrulyLocalAdvice, and it's taking place during the month of November. What this is you can ask us a financial question on Twitter or Facebook or via email at trulylocaladivice@penfinancial.com, and you'll be entered into a draw for $1,000. One of our financial advisors will then personally answer your question for you. We've had all sorts of great questions throughout the last couple of days, so we encourage you to keep them coming and to spread the word. And also, just as a special bonus, anyone attending the webinar tonight who wants to ask a question, we'll enter you into the $1,000 draw just as a special bonus for engaging in the presentation. So we invite you to do that. So without further ado, I'm going to turn it over to Rob now to take you through the Investing 101 webinar.
Thank you, Josh. Welcome, everyone. Glad you can join us. This evening, Linda Larouche and I are going to talk to you about the investment planning process. We're going to cover a number of different topics, and our goal this evening is to hopefully you'll take something away and be able to utilize it in your own financial life. Specifically, we're going to talk to you about setting goals, determining your investing profile, choosing your asset mix, as well as choosing those investments, and then talk to you about how to track your progress to see if you're headed in the right direction towards your goals. So let's get started. What do we do first? Well, we want to figure out what the current financial situation is. So we want to determine exactly where you are. And where you are includes what assets do you have? So what do you own? House, car? What investments do you currently have? Do you have RSPs to date, tax-free accounts, maybe just a cash savings, maybe your money under your mattress? But we also want to figure out what do you owe? So do you have a mortgage? What's your rate on your mortgage, your interest rate? Do you have a car loan? Do you have student debt? Maybe some credit card debt? What we're trying to accomplish is to determine where you are in terms of net worth. Then we're going to focus on what you earn. So what incomes do you have? What is your family income? Your salary? Are you working? Maybe there's some pension income, depending on the stage of life you're in. Then we're going to talk to you about what you spend. So the most important, I think, is the fourth one, is what you spend. There's a misconception out there, and with the members that I've met over the years, people really don't have an understanding of how much they spend. And the goal as an advisor is to figure out what cash flow we have available to work with. I always urge members when I meet with them to track their spending for a period of time, maybe 1 or 2 weeks or a month, writing down every single expense that they have so that we can determine with them what it is we have to work with. I think everyone's heard of the latte factor and what they spend on Tim Hortons or maybe Starbucks. Those things are important for us as advisors in getting you started in the investing planning process. So firstly, we want to talk to you about financial goals. What is a financial goal? Well, it could be anything. It could be when you want to retire. It could be saving for an emergency. It could be a child's education, purchasing a car. Any number of things. What's important is to be specific and realistic. All too often we hear members or clients saying that, I'd like to retire comfortably. Well, that's too vague for us. Be specific. I want to retire by 55, maybe set a second age. I want to retire no later than 65, but really my goal is to be retired by 55. And I want to retire with an income of no less than $50,000. So how do we make that happen? Your goals also should be based on your current financial situation. So we spend the time figuring out where you are currently And we look at what goals are achievable based on what we have to work with. So again, knowing what you own, what you owe, and what your cash flow situation is like, we can then take and determine where we can put the money to work for you. 6 questions to ask yourself when you're setting your financial goals. What are your top financial goals? Is it buying a house? Is it retirement? Is it saving for your children's education? And then, when do you want to reach those goals by? 5 years to buy that house? Want to retire by 55? How much money will it take to reach each goal? So obviously, if it's buying a home, it's a very large cash outflow. It might include having to take out a mortgage. So there's considerations to be had there. How much can you afford to save towards each goal? That comes out of that first step in determining your current financial situation. And what will you gain or lose by putting one of your goals first? So prioritizing those goals. So if I choose to save for my home now, am I going to put off retirement for a later date? The key important thing is when you're determining your goals, though, is the choices you make help you enjoy a better quality of life today and in the future. We don't want to compromise today for the benefit of tomorrow. We want to be able to balance both of those. Once we've looked at your current situation, understanding what your goals are, then we need to determine, based on those goals, what your investor profile is. In some instances, your investor profile will be specific to the goal, but generally, for most, your investor profile is generally overall on your goals. And what is an investor profile? Well, it's your personality. It encompasses a number of different things. What's your tolerance to risk, so on and so forth. And I'm going to get into that a little bit more. 4 considerations for determining your investor profile. There are 3 things, basically, that we look at when we're determining an investor profile for a member. What is the purpose you're investing for? That is the main one. Is it retirement? Is it to save for a house? Is it to save for your children's education? Emergency fund? Each one of those has different considerations. And what is the time commitment on the investment? Is it 5 years, 10 years, 25 years? And what is the rate of return that I desire? One of the things that I use when I talk about investor profile with members is rate of return. So why, if we need a rate of return of 7, but I would like to get 10, well, if 10 doesn't fit with what I need, then why take on the extra risk to get the 10%? So it's about the desire and what we need to get where we want to go based on that goal conversation. And then lastly, how much am I willing to let my investment fluctuate up and down? And I don't, the alternative word for that is risk, which I'm not a fan of because it has that negativity to it. It's more or less fluctuation. So how much am I willing to let my investment go up and down? Is it to a small degree or to a large degree? So once we consider those 4 things, we then take a look at where to put the funds for you. There are 3 basic types of investments that are included in investor profile. Cash and cash equivalents. So those include savings accounts, GICs, or guaranteed investment certificates, money market funds and the mutual funds. It could also include money you have hidden under your mattress. Then there's fixed income investments, long-term guaranteed investment certificates, bonds, fixed income mutual funds. It could also include mortgages. So if you lend some, it could even include a loan. Equities, those include stocks, equity mutual funds, ETFs that are most recent in recent years that you hear a lot about. But basically what we do is we look at where we're going to put the amounts of your investment in each of those different investment types. So how much goes in cash, how much goes in fixed income, and how much goes in equities. When deciding on how much to put in each of those investments, what essentially we're doing is creating your investor profile. There are 6 types of investors out there: secure, income, conservative, balanced, growth, and aggressive growth. And throughout my career, I've learned an acronym for it, which I'll share with you because it's stuck in my mind forever, and it's SICPGA. So you can choose which one you are based on your conversation with your advisor, much similar to the process we're taking you through now. When choosing your asset mix, I like to equate it to an analogy that I use in my conversations with members. Consider yourself standing on an elevator, and one elevator has one cable holding it up, the other elevator has many. If a cable was to break on each of those elevators, which one would you want to be standing on? Of course, for obvious reasons, you'd want to be standing on the one with many elevator cables. The same principle can apply to choosing your asset mix and choosing your investments, which we're going to talk about. Building more elevator cables to your portfolio helps to stabilize your investment and ensure that if one cable breaks, there are other cables to keep you afloat. How does that equate to who you are as an investor? In this particular slide, you'll see the 6 types of investors: secure, income, conservative, balanced growth, and aggressive growth. And you'll notice that as you go further towards or higher fluctuation or risk, the more equity you're adding to your portfolio. For somebody in a growth portfolio, that could be 5% cash or cash equivalents, or 5% stashed under your mattress, 25% in fixed income, or in long-term GICs, could be mutual funds, and 75% in equities. So the idea is that the further along you go from secure to aggressive growth, you're adding more of those equities or those fluctuating investments to your portfolio. Interestingly enough, the more equity you add to that portfolio or stock market investments, you'll notice that the opportunity for return increases. And I mentioned opportunity for return because as you add equity to your portfolio, there's never a guarantee on the return you can get from those. When choosing your asset mix, the following should apply. So it should balance risk with that expected rate of return. So if I need 5% to achieve my goal, then the asset mix should align the risk with an expected rate of return of 5%. It should match my tolerance or your tolerance as an investor for that fluctuation. You don't want to be in an aggressive growth portfolio if your tolerance for fluctuation is an income portfolio. It should also provide access to money when you need it. So for instance, life does happen. Sometimes we need to access our investments for a short-term emergency. And is there a contingency plan? Are you able to access some of those funds if you need it? And then, most importantly, your asset mix or your investment should also provide the growth you need to reach your goal. Going through the investment planning process and determining what you need to reach your goal is extremely important, and your asset mix should align that. Also, as time goes on, be prepared to adjust as your needs and your goals change, because you may have a goal today, but that might change a couple years down the road depending on your financial circumstances. Bottom line, work with a qualified advisor to choose that asset mix. So once we've chosen where funds need to go as far as the cash, the fixed income, and the equity, we need to determine what vehicles we're going to use to put the money in. There are many different types of individual investments, and there are many different types of plans. As you can see, deciding what to invest in could be GICs, could be individual stocks, could be bonds, could be real estate, could be exchange-traded funds. A consideration that Linda will talk about a little bit more in detail is how those investments are taxed and what plans are available that have tax advantages. First off, we need to determine what type of plans that we're going to utilize in an investment strategy. For instance, if we're looking at retirement, we're going to look at RSPs. RSPs are registered retirement savings plans, a vehicle to help you save for retirement. It could also include tax-free savings accounts. They could be utilized for retirement as well, or any other goal for that matter. Registered education savings plans for education, registered disability savings plans, which is relatively new, however very lucrative to those who have disabilities. And then non-registered investments are any investment outside of those registered plans. They can include the money under your mattress. We're going to watch a short video talking about the different types of plans, and then I'm going to turn it over to Linda to go into more about the investment options that you have.
We could all really use help saving money. After paying taxes and our basic living expenses, there never seems to be anything left over. There are a lot of plans available though. This video will introduce you to some of the saving plans you can use to put money away for the future. For most people, the simplest way to start such a saving plan is with a registered plan, like a tax-free savings account or registered retirement savings plan. They are well known, widely available, and there's one to suit every savings goal. Registered plans are different from other savings and investment plans because they can give you income tax savings, and in some cases, the government will even add money to your plan. These savings plans are registered with Revenue Canada and let you reduce or defer income tax. The main types of registered savings plans are RRSPs, or Registered Retirement Savings Plans, TFSA, Tax-Free Savings Accounts, RESPs, Registered Education Savings Plans, and RDSPs, Registered Disability Savings Plans. Let's take a look at the different plans and how they can help you save. RRSPs are designed to help you save for your retirement. The benefit of this plan is that the money you invest in the plan is deducted from your income, so you don't pay tax on it right away, and you don't pay tax on earnings in the plan until you withdraw them. When you decide to use your savings, then you will pay income tax on the money you take out, including any income the savings have earned. You may pay lower taxes on the money in the plan when you take it out in the future, as most people enter a low tax bracket after retirement. TFSAs can be used for any savings goal, and you can hold cash, stocks, bonds, or almost any type of investment in a TFSA. The income the plan earns is not taxed. RESPs are designed to help you save for your child's education. Money in an RESP can receive grants from the governments of Canada, Quebec, and Alberta, which are added to the savings. When the money in the plan is used for the child's education, the money the plan has earned and the grants are considered the child's income, which is often tax-free or taxed at a lower rate. RDSPs are designed to help you save to support a person with a disability. Money in an RDSP can also receive grants from the Government of Canada, which will add to the savings. And the money the plan receives or earns that is used to support someone with a disability is often taxed at a lower rate. Many conditions apply to registered savings plans, so be sure you understand them so you can decide if they are the best way for you to meet your savings or investing goals. Whatever you are saving for, your retirement, a child's education, a costly item, or support for a person with a disability, registered savings plans can help you achieve your goals while reducing the current taxes you pay. Most financial institutions offer a variety of registered savings plans. Talk to your financial institution or to an independent financial professional to decide which plan is best for your savings goals. To build your financial knowledge, go to your financial toolkit at itpaystoknow.gc.ca.
Thanks, Rob. Continuing with how to choose your investments. Within Canada, there are three basic ways to make money or earn income from your investments. One method of earning investment income is interest income. Interest income can be earned from investments such as T-bills, GICs, term deposits, or bonds. As many of you are aware, interest income is 100% taxable. Every dollar you earn must be reported as income and is taxed at the highest rate, the same rate as employment income. A second method of earning investment income is dividend income. Dividend income can be earned from investments such as stocks or mutual funds. Dividend income is taxed more favorably than interest income. With the dividend gross up and the dividend tax credit, the end result is that you only are reporting approximately 65% of the dividend earned as income, resulting in a 35% tax savings. The third method of earning investment income is capital gains income. Capital gains income is earned through investments such as stocks, mutual funds, and sometimes marketable bonds. Capital gains is the most efficient way of earning investment income from a tax perspective. Only 50% of your capital gain must be reported as income, resulting in a 50% tax savings on that investment income. The traditional vehicles for interest-earning investments are registered accounts, such as RSPs, tax-free savings accounts, RESPs, because the interest is 100% tax-sheltered in these plans. Tax dividend income and capital gains are used in a non-registered investment income to take advantage of the tax efficiency of the income. Remember, dividend income and capital gains may be tax efficient, but with tax efficiency comes risk. During capital gains and dividend income, you have to invest in the market, stocks, mutual funds, etc. There are no guarantees here. Interest income may come from a GIC term deposit that is 100% guaranteed, no losses. So you have to carefully find that balance between risk and tax efficiency. Now you are ready to build your portfolio based on the preliminary work you and your advisor have completed. You have established a goal or goals, as Rob mentioned. This should be the very first step in creating an investment strategy. You have determined your investment profile, likely through a questionnaire that you and your advisor have completed. Your profile has determined the asset mix required. Remember the elevator slide? You need to be diversified. You are now ready to choose the type of investments that meet the asset mix required. The chart that you see here outlines a few of those investments, such as mutual funds, stocks, GICs, bonds, ETFs, real estate, etc. Remember, the list in the chart is not inclusive of all investments, and you may likely only hold a few of these to create an investment portfolio that meets your profile. Now, before I move to the next few slides that will focus on mutual funds, I would like to briefly comment on GIC or bonds. This is the investment or investments that will comprise your fixed income portfolio, as in the example of the slide that you are looking at that requires 40% fixed income. This investment will reduce volatility in your portfolio. And for short-term time horizons, such as emergency funds, investments such as GICs are very appropriate as there is no risk. The money is there when you need it. As noted on the previous slide, one of your many choices are mutual funds, a very popular investment choice when building investment portfolios. As you see in this chart, there are many ways a mutual fund can be designed based on assets. One may be fixed income, which may include various types of bonds. Another could be equities or stocks, and these can be diversified by management styles such as value, growth, or blended styles. Equities can be further diversified by geography, whether those equities be in Canada, US, or Europe, and/or, again, further diversified by sectors such as financials, precious metals, and energy. The end result is that there are a multitude of mutual fund choices, and this can be overwhelming for the average investor. Your investment specialist will help you in selecting what is best suited for your profile and asset mix, which you have established in the early stages of creating your investment portfolio. One obstacle to investing for many people is to avoid chasing last year's winners in the marketplace. Stay focused and diversified. Stick to your plan. Looking at this chart, besides being a very colorful slide, this slide has significant relevance. Each color represents a different sector of the global market. You'll note that not one color is consistently at the top or the bottom of the chart. What this chart tells us is not one sector consistently performs better than another. That is why it is so important to stay diversified. Recall the slide you saw earlier regarding the elevator choice, one cable or several cables. The important message here is to stay diversified. Stick to your plan. Another few important rules for investing. Contribute early, and we will show you the benefits of doing so in the next few slides. Contribute often and contribute regularly. Regular contributions to your investment will significantly help you grow your investment. It becomes a good habit, just like paying your bills monthly. Treat your contribution as a monthly commitment or payment to your future. You will benefit. Contributing the same amount on a regular monthly basis will benefit you in a couple ways. Growth of the investment at a faster rate, as well as creating dollar cost averaging. If you contribute monthly to an investment such as your RSP or RESP, in which you are purchasing mutual funds, dollar cost averaging will reap rewards. As funds go up and down, you are dollar cost averaging. You're buying more units when the price is down and fewer when the price is high. It's very difficult to time a down market to purchase a lump sum, and to be quite frank, emotionally people hesitate to do so and miss out on the buying opportunity. Monthly, regular contributions do pay off. Here's where we'd like to show you how quickly it adds up. We're going to show you an example of an individual, age 30, wanting to retire at age 65, annual savings of $1,200 a year to an RSP, and pre-retirement return of 7%. Of this investment total that you see, $165,884, by investing in this method, only $36,000 of this money is your own contributions. The remaining $129,884 is growth. This $165,884 will in turn potentially create an annual income of $23,769 for the next 25 years if you are able to earn a rate of return of 5% during retirement. Starting early really pays off, as this example shows. To further emphasize the importance of starting early, the above examples are provided. Starting at age 25, investing $1,200 per year for 40 years, the sum of $239,562 represents only $48,000 of your own funds, plus $191,560 of growth, versus starting at age 45, investing the same amount for 20 years, the sum of $49,194 represents $24,000 of your money and only $25,190 of growth. Again, these examples show you that starting early really does pay. You have created an investment plan based on your goals. Now you must track your progress. This is so important. Track your progress against your goals. Review your statements. Stay invested. Meet your advisor regularly. Rebalance your portfolio. Does your asset mix need to change? Maybe you're getting close to retirement and need more fixed income. Are you still on target to meet your goals? Everyone remembers the crash of 2008. It's hard to forget. The TSX was down 50% in 1 year. It was difficult to escape all the noise, but it was very important to stay focused. Remember, if you are in the market, your goals should be long-term so that investments can bounce back and over time erase the volatility. This chart shows you that since the low of 2008, the S&P TSX Composite has recovered, but it took time. It did not happen overnight, as you can see. It took 6 years to recover. This chart shows you, or graph shows you, the power of diversification. what this graph shows you, and we keep stressing this important rule about diversification. The solid line represents the S&P TSX composite we saw in the previous slide. The dotted line you see represents a balanced mutual fund. If in 2008 you were in that balanced mutual fund, your investment did not drop as much as the S&P TSX composite. Your investment likely only dropped 28%, where the TSX dropped 50%. This was still a significant drop, but if you held the course and stayed focused on your long-term goals, you likely recovered within 2 years versus 6 years. Moral of the story, yes, there are going to be downs in the market, and maybe some significant ones, but the overall trend is upward over the long term. Diversify and stay invested. Ignore those short-term fluctuations. Investing is complicated, we know that, but it doesn't have to be for you. Leave the mechanics of investing to the specialists, and let those specialists help you reach your goals. Here's a quick video highlighting a regular investor seeking out the right investment specialist to achieve her goals.
9 million Canadians rely on financial advisors, trusting them with their fortunes and their futures, but they are lightly regulated. CBC Marketplace took a hidden camera inside the industry for the first time in Canada and found a world of shoddy training, false promises, and your money on the line. Erica Johnson brings us the exclusive story.
There we go.
Like most Canadians, Melissa Carrero worries about her family's financial future.
Just because you're picking me up there?
So we're wiring her up with hidden cameras to test financial advisors, the people 1/3 of Canadians turn to every year.
It's important to people my age to know this information.
As part of our test, we want to find out what kind of returns advisors say they can get Melissa if she invests $50,000.
Let's say 10,000 after a year, or 15,000, or maybe 20,000 after a year.
That's ludicrous.
We show our footage to Preet Banerjee, an independent financial expert who used to be an advisor.
Quite frankly, he's either incompetent or he's lying. Those are the only two possible answers for giving an answer like that to someone who says that they're a conservative investor.
That advisor's parent company, Scotiabank, tells us the company accepts responsibility that the advisor made a mistake and has been suspended pending a review. Other financial advisors make unrealistic promises of returns too. And when it comes to how much it'll cost Melissa to invest, some advisors are vague, mislead her, or just don't know.
It's like, sorry, I just want to make sure I'm thinking about this properly. I can find like an easy definition.
If you can't explain the fees on a mutual fund, which is such a popular investment in Canada that almost $1 trillion is invested by Canadians in them, you should not call yourself a financial advisor, period.
RBC wouldn't do an interview, but in a statement said it looks for ways to help employees give our clients the best advice possible.
Our investigation also found advisors who didn't ask about our tester's debt or her tolerance for risk on the markets. And the regulators who oversee this industry, not one would talk on camera. Erica Johnson, CBC News, Vancouver.
Tomorrow night, see how the companies score and what you need to know before visiting a financial advisor. That's on Marketplace at 8 o'clock, 8:30 in Newfoundland.
I think the video you just watched was very relevant, and if you question the advice that you're getting from your advisor, we strongly suggest that you do get a second opinion. Your money is very important in your future, so always get that second opinion if you feel necessary. As with any goal, whether to get safely to High Prairie, Alberta from Welland, Ontario, you need a map and the proper tools to get there. This goes for investing as well. There will be bumps and detours along the way. That is why you should seek out a qualified investment specialist to guide you and help you ensure you meet your goals with a simple, successful solution: banking made lighter. We'd like to thank all of you for attending our webinar, and we just want to go over a little bit about who PenFinancial Credit Union is, PenFinancial Credit Union has been a credit union in existence for over 60 years in Niagara. We are 19,000 members strong, $430 million in assets, 94 employees, 8 branches, 1 commercial business center, a wealth management division. We are local and accessible. We are nimble and innovative, and we're small enough to care, but big enough to trust. How are we similar to a bank? Well, we offer the same products and services. We have competitive rates. We have branches throughout Niagara. We offer internet banking, mobile banking, telephone banking, automated banking machines across the country that are ding-free. We have a full range of products to help you achieve your financial goals. How are we different? Well, we're Niagara-based, owned and operated. We are a cooperative financial service organization owned by the people we serve, our members. Credit unions make decisions based on the best interest of our members. All decisions are made locally. Income is reinvested back into our Niagara communities. We're accessible, transparent, negotiable, genuine, honest, and fair.
Okay, so thank you guys very much for all of your information. A lot of good information. If anyone has any questions at all, feel free just to type them in the chat area on the right side of the screen, and we'll hopefully get them answered. And we did have a couple of questions that came in. The first question is from Jen, and Jen asks, the webinar referred to laddering GICs as a way of diversifying when making investment choices. Will you please explain to me what laddering is? I don't know which one of you wants to handle that one.
Well, this may sound like a little canned answer, but I did have this question asked of me earlier today, so I do have a prepared answer. Laddering is a recommended strategy that we as advisors use quite often when investing in fixed income. Simply, you take your initial investment, and I'll use a nice round number of $50,000, and you divide it into equal portions. That may be 5 equal portions of $10,000 each. And it is invested in a combination of term deposits or GICs ranging from 1 to 5 years. Typically, the longer term of the investment, the higher the return. Each year an investment or GIC matures and funds are used to purchase a new 5-year investment, which is usually the highest rate in the marketplace. You have access to your money every year if required if you decide not to renew the whole balance. If interest rates rise, you can take advantage of the higher rate because you have money coming due every year. And if interest rates are falling, fortunately, you have a large portion of that laddered portfolio invested longer term. So laddering really what it means is it's maximizing your returns within that fixed income portfolio. It's reducing risk, taking the guesswork out of where interest rates are going to go, and gives you convenient access to your funds annually.
That's great. Hopefully that answered your question, Jen. Second question that has come in is more of a situational question from Steve. So for the past 15 years, I've been saving for my son's post-secondary education in an RESP. In 2 years, he will need to start using these funds, and I anticipate that all of it will be used within 4 years' time. It is the only savings we have put aside for his education. I have 100% of the RESP in mutual funds. Not sure but it's done well until recently. So Steve's question is, should he consider changing the investments?
I'll take this one, Steve. Given you mentioned that your 15 years have been saving and your child is 2 years from going to school, given you mentioned too that there's been some fluctuating value in your portfolio, it's probably a good time to sit down with your advisor to discuss the investment that you're in, because given the fact you need those funds in 2 years, you want to ensure that you've minimized, if not eliminated, any risk from the portfolio, so that if there was a downturn in the market between now and 2 years, you're going to have the money that you've saved for the last 15 years and ensure that it's all there. So it's probably a good time to take a look at it and see if another option is available to reduce that risk. Not knowing what your portfolio consists of, maybe that it is done, but given the fact that you've said it has changed recently, it might be worthwhile looking at.
So just maybe for those who aren't as familiar with RESPs, what are some of the investment options that someone like Steve might be able to consider?
Mutual funds themselves have low-risk options, so there's a fixed income portion that I mentioned at the start of the presentation. It could be a bond mutual fund that is a low-risk option. The GIC or GIC laddering strategy is something, given that there's only 2 years, maybe not laddering, but GICs are an option as well. But at this stage in the savings plan, the closer you reach your goal, you want to reduce that amount of risk that you're taking on. When the child's young, in the early years, you've got time, and the crash is a perfect example of 2008. It took 6 years to recover from that crash if you were 100% in the market, or even some exposure to that. So if he's in an equity high portion of his investment right now, if there was another crash to happen next year, child going to school the year after, there may be some potential that the funds he saved for 15 years aren't there. So there could be other options to look at other than mutual funds themselves or within the mutual funds universe. Yeah.
Okay, we had one more question come in. Thanks, Rob, for that, by the way. And the question is, how much does the investing advice cost through PenFinancial branches?
This one, it's free, basically, because you are a member. Our advice is free. We want to sit down and have that conversation with you to make sure that you do reach your financial goals and continue to come to us for that advice. Rob, would you like to add anything to that?
Yeah, and we are, your time is important, and sitting down with us, it doesn't cost a cent. You know, we'll give you some advice, our opinion. If you're unsure about your portfolio, it doesn't cost anything to take a look. We want to help you achieve your goals, and if we can do that, we're going to do it without having it cost you anything. So,
I think in some cases people might be intimidated by the whole process, especially if they don't necessarily have a lot of money to invest, or maybe they don't even have a portfolio yet. What would you say to someone who's maybe just a little bit nervous about that whole process?
We like to keep it simple for you. We're not in the business of intimidating our members. We want you to succeed, and starting young with very little, well, we can really help you become successful going forward, and that shouldn't scare you away. That's the perfect time to start, actually.
Awesome. Well, thank you guys once again for all of your advice and information here tonight. And I don't see any more questions, so that officially concludes our Investing 101 webinar. So I want to thank you guys once again for joining us. A friendly reminder that this webinar was recorded, so if you head to the PenFinancial website there, on the right-hand side of the screen, you can see our webinar center. So within a few days, we'll be posting up the recorded webinar there, so you can watch it again if you missed some information, or you can feel free to share it with your family and friends. As always, we're always open to topic ideas, so you can feel free to email us at penfinancial.com, or you can send us a tweet or post on our Facebook page, just different topics that you'd be interested in seeing, and we'll be happy to try and cover them for you if there's enough interest. A reminder once again about our hashtag Truly Local Advice contest that's happening until the end of November. So if you do have a financial question, feel free to ask it to us on Twitter, Facebook, or email us at trulylocaladvice@penfinancial.com, and you'll be entered into the draw to win $1,000. So feel free to do that. So thank you once again for joining us, and have a great night.